always. I mean, if you haven't invested in any commodity, you start with gold. There's more information. It's easier to understand where demand is coming from in gold because it's from all the central banks in the world, which have been increasing their reserves by a record amount each year, and will continue to do that, to have gold as a sort of anchor aside from the US dollar, which has been the sort of more prevalent central bank reserve currency. It will stay that, but gold is becoming that anchor for other transactions and trade across the world, across countries.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the show. We're live again from the Rural Symposium here with Dr. Nomi Prince. How you doing today?
I am doing well. Thanks for having me on. First thing in the morning.
Yes. It's been some long nights here.
Yes.
You know, a lot of networking, a lot of fun, building, relationships, and some of these relationships last years, with folks here. So that's something that I'm happy to be a part of, third year coming here.
Yeah, no, the relationships here, this particular conference, for informational purposes, trend purposes, relationships, I just think is second to none.
Mm-hmm. Yeah, for sure. So what are some of the thoughts like you've came in with? Because I know you've given some presentations and there's a lot of things happening out there. And so what are some of the main things that you've kind of come in with, like in perspective, and things that you may want to impart to the audience here?
Yeah, so some of the main things, and I started actually, my talk was going to be gold, silver, copper, uranium, rare earths, and the geopolitical and monetary reasons why each of those individually is important. And one of the interesting things that has happened, like just in the last couple days while we're here, for example, for copper, the White House just came out with a potential 50% tariff on copper. I had been talking about an investigation into copper's necessity as a critical mineral for defense purposes. White House was undergoing a study on that called a Section 232 investigation. Also, results from that appeared to be at least coming into President Trump, or earlier than we might have anticipated in September. So it is important, it is critical. That has bumped up copper prices, for example. So I wasn't gonna star copper in all that array. All those materials are important, but that happened this week. And just this morning, the Department of Defense and MP Materials, which is the major rare earth company in the United States, announced a $400 million government-backed loan to MP Materials to create permanent magnet processing capacity at their site in order to combat the fact, and I talked about this in my speech, that China controls about 90% of that processing in the world. So as we're here, and as different participants are representing these assets, these hard assets, things are happening in the world very, very quickly. So it's a very important time for people, for investors, to look at this space. Yeah,
agreed. And I'm subscribed to your newsletter, which I'm gonna link in the description below. But you've been talking a lot about like what's happening with rare earths and some of these other developments and things of that nature. And so I always appreciate you being on top of that, because I didn't even know what happened this morning. I did see the tariff on copper a couple days ago. I was actually having a conversation with a copper streaming and royalty company, and then that headline just popped on my phone. And
they were happy.
I was just like, oh wow, I may need to buy some shares. But so thinking about that, there's a lot of opportunities there, and where are you seeing like the most opportunity? So like obviously gold has run up to close to 3,500. And came back down a little bit. I think it's just consolidating when I look at the charts. Silver's run up to $37, and cooled off a little bit, but it's still hovering above there. You got opportunities in copper, rare earths. There's so many different developments and things that are needed. What are like the most like bullish sectors that are bullish commodities that you've seen?
Yeah, I mean, I think you've mentioned a lot of them. So in our model portfolios and in the ones I invest in personally, which are in similar names, and I disclose all that, they're across all of those asset classes. So it is gold, it is silver, it is copper, it is uranium, and it is rare earths. And then, I look at some of the utilities or logistical capacities and transportation that move those things from one place to another around the supply chain. LNG a little bit, natural gas, not so much the topic for this week. But I believe you need to be in all of those. I mean, if you haven't invested in any commodity, you start with gold. There's more information. It's easier to understand where demand is coming from in gold because it's from all the central banks in the world, which have been increasing their reserves by a record amount each year and will continue to do that, to have gold as a sort of anchor aside from the US dollar, which has been the sort of more prevalent central bank reserve currency. It will stay that, but gold is becoming that anchor for other transactions and trade across the world, across countries. Silver is important too because silver has industrial uses with strategic long-term plans behind them from China, from India, for solar capacity, for building defense systems, for building infrastructure that outstrips the supply from the ground. It takes a minute to open a mine and make it functional, and there's just a dearth of supply right now. So I think silver is going to really jump up, maybe not in the next 2 minutes, but I think we're going to get above the 40 level by the end of the year, and I think next year we're looking at 50, 60 because this demand isn't stopping and the supply is not going to be able to keep up. Copper, we just saw that bump up over 5.5 this week on the announcement of those tariffs. Whether or not they become fact, or whether or not there are negotiations with certain countries for side deals, which there always are, the demand for copper for electrification does outstrip supply. Uranium, the demand for uranium, especially domestically allied enriched uranium, is tremendous relative to supply. And rare earths, which most people don't actually know about, but is in everybody's cell phone. Everybody carries a bunch of rare earths in their pocket every day. And this deal that the DoD just did with one of the larger US companies is just a foreshadowing of what is happening in this space that people aren't paying attention to. So I think you have to be in all of them, but if you need to start somewhere, do it in that order. Do gold, do silver, do copper, maybe uranium before copper, but basically those two, because you got a base metal, then you got an energy element, and then you go to rare earths, and that is a very good long-term portfolio.
Yeah. Got it. And what's kind of your forecast on like gold? Where do you think gold lands, by year end? Do you have a target?
I think we're at 4,000 by year end. I mean, as you mentioned, this consolidation around the 3,300 level, I think is happening basically just as a breather. And we don't really get numbers every day from central banks in terms of what we buy. We tend to get quarterly numbers. So what happened was we got the first quarterly number. We had a bump up of gold from 3,000 to around the 3,500 in April because that's when the numbers started coming up for the first quarter. Then it came back down because of various profit taking and other selling going on around, with retail, with wealth, family wealth, whatever, just to kind of monetize some of the gold at the high level. So you had a little foundational drop. Now you have a band. We're going to get another quarterly report from central banks happening soon. I think that's going to show more buying that's been happening, and that's going to push the price of gold back up. And I think ultimately retail, particularly Western retail, is going to come in and notice this in terms of allocating portfolios. It's still very, very under allocated. Not so much in the East. People are buying gold in the East at the retail level, less so on the West. So there's a huge amount of opportunity. So I do see getting up to 4,000 at the turn of the year and up to 5,000 by the turn of the next year, which is a really healthy return. Gold has outperformed NVIDIA this year. Silver has outperformed gold, and silver has outperformed NVIDIA. So there's certainly value in these sectors that people really don't see splashed across headlines like some of the big tech companies.
Yeah, for sure. Yeah, they're not the most exciting assets, for some folks. So there was even just tapping into like some of your banking, experience. There's been some talk about some of the rules changing for big banks to own more government debt or whatnot. And I don't know if this is like to finance some of the deficits or whatnot, or kind of like an additional way of money printing or something of that nature. Is that something that you've been kind of keying in on as well?
I have. Well, it's almost, that's what they're saying. It's almost the opposite. What they want is more freedom to be able to get rid of their treasuries, disguised as more freedom to own more treasuries. It's a very sort of tricky situation in terms of how it gets reported and what they're actually trying to do. What they're actually trying to do is really not have to hold as much of a treasury bond portfolio. They want to be able to use it to leverage into more trading, more speculative transactions. So I am concerned about that, because whenever you don't have an anchor in terms of more secure assets underlying the other activities you're doing as a bank, as a financial institution, you can run into problems. I mean, treasuries aren't perfect. I don't invest in treasuries, but they are secured by the US government. And so not having something of that nature, it's called a tier one asset, or basically, underlying any other risk that a bank could take, does worry me. It worries me in terms of what they can do on the other side of that with that money.
So pretty much the banks can engage in more risky behavior. Is that
That's
kind of
basically
like
right? Yeah. So instead of keeping that sort of the boring treasuries in your back pocket of a bank's book, they don't have to keep. They're trying not to have to keep as much.
Okay, got it. And has those rules like changed or anything, or are they just being like talked about?
They're being talked about.
Got it. Yeah. And then what's your projection for like the Fed? Do you think more rate cuts are coming, or is the quantitative tightening going to continue? What's kind of your perspective there?
Yeah, so quantitative tightening, basically the Fed letting treasuries roll off its book. The Fed doesn't want to sell its treasuries. What this quantitative tightening is, it's a wonky way of saying we have had treasuries, we've bought them out of the market because the market didn't want them, so we bought them. And as they mature, we just won't replace them with new ones. That's the Fed's definition of quantitative tightening. They're not selling into the market. They're not making the value worse because they have so many, but they're letting them not be replaced. The speed at which they're not letting them be replaced has gone down from them letting $75 billion a month about a year and a half ago roll off their book to just $5. To me, that's a rounding error on a $6.8 trillion book of assets. It means nothing to me. So to me, they can call that quantitative tightening all day long. To me, they're in a neutral position getting ready for easing or to potentially buy treasuries if central banks won't buy as many, if the market won't buy as many, in order to keep the rates at those longer parts of 10-year and 30-year maturities from not continuing to stay as high as they are, which they are high relative to the short. I think they're also going to cut rates by 75 to 100 basis points. I'm very out there on the 100 basis points, but I said this last year as well, earlier in the year, that they would cut 100 last year, and ultimately they did. It took a while for them to get going. I think the same thing is happening this year. They haven't cut rates at all. This is the first half of 2025. And I think part of that's this ego battle between Jerome Powell and President Trump. President Trump wants the Fed to cut rates. Powell wants to control inflation and be independent. There's a little bit of a battle there, but I think ultimately Powell will look at the numbers, and that's what he says anyway. And the numbers outside of inflation are that growth is slowing. Jobless claims are rising. The unemployment rate is rising. That's generally an environment into which you ease rates.
Yeah, got it. Yeah, and it seems like, Powell, we can argue whether the Fed is a good thing or not, but I guess technically they're supposed to be independent. And so that's kind of been like an interesting thing that I've been seeing with the pressure to cut rates, or it's kind of like interfering with that independence in some way. And the Fed has their own goals with inflation, and then now with the tariff situation, like they're kind of like, okay, let's pause and wait and see what happens first. And his term is up next year?
May 2026.
Okay, yeah.
So there's gonna be so whether or not he stays kind of where he is at in inflation. There's going to be someone at the helm of the Fed that's going to ease policy. And I think the market's ahead of that. So whether it is 100 basis points this year, ultimately, as I think it might be, or whether it's 75, the market knows that whoever replaces Powell is going to be, even though it's not actually handpicked by President Trump. When you have a Congress that's effectively on the Republican side and aligns with his views, you're going to have a vote to approve whoever it is that is put up as an appointee to run the Fed, and that person is going to be someone that matches the policy of the White House. So whether or not they operate independently or not, that's how it's going to go down. President Trump is not going to put an appointee in there that he doesn't feel aligned with. I mean, it just doesn't work that way no matter who you are as president.
Yeah, got it. And that's kind of like been something a dynamic that I've been kind of looking at and just trying to understand more. Big Beautiful Bill was passed. I don't know why they named this stuff stuff. Like, I'm just like, come on, just name it.
Name it something like normal in legislative language.
So the Big Beautiful Bill just passed, and I was actually catching a little bit of David Stockman's presentation in the symposium, and he was showing like the increase in the deficits. And so it seems like there's been a total shift in I would say the Republican Party. Not everyone. I mean, there's a few that voted against the Big Beautiful Bill. I think Rand Paul and someone else did. But just thinking about that, like the sentiment going from cutting, getting the deficit under control to like, okay, now we need to focus on growth because we can't decrease the deficits. The $2 trillion was a lofty goal that was reaching for pie in the sky. And then now we have this bill that increases the deficit. So what does that mean for, like, does that mean anything for the economy or markets? Like, what's kind of your analysis there?
Yeah, I think the market is kind of over-caring what the deficit is, because the market just recognizes the deficit's growing, debt's growing. And as a result, the equity markets actually have more value in terms of upside relative to the cost of debt, because if you have more debt, particularly in the long end, which is what we've seen, the rates kind of stay. They stay where they are high, but there's more opportunity potentially on the equity side, certainly on the hard asset side, as we talked about. So I don't think the markets actually care that much, but having so much debt does get in the way of growth, because what it means is before anyone in Washington wakes up, before they turn the lights on, they have to pay the interest on the debt. The interest on the debt is around $1 trillion a year. It's half of the value of the deficit. I'm not saying that the deficit includes the trillion of debt. It actually doesn't. But the amount of just interest payments on the debt is astronomical. And what that means is you can't use $1 trillion to build infrastructure. You can't use $1 trillion to upgrade electric grids, which is necessary. You can't even use $1 trillion extra to replenish certain defense missiles, right? So it does have this like depletive effect on where the country can grow and therefore where jobs can be created. I mean, there's a knock-on effect to all these things because you have to service that debt. If it was just debt at 0%, all day long, and to an extent it was when QE was as big in operational rates at the short end were at 0. It's a bit more expensive than that now, and it's rising to that $1 trillion, and that becomes a problem with growth strategies.
Got it. And is there any type of implications for? I mean, obviously the tax cuts is a part of it, and I think those are set to increase by the end of this year, and then now those are set to be permanent or whatnot. Does that mean like companies become more profitable, or it's just the same as it's been because the goalpost hasn't, or the cuts haven't really moved, like it's the same percentages?
That's an interesting. They basically extend cuts that were already in operation, but it's still positive for corporations in terms of their tax bill.
Okay, got it. And I imagine it probably gives some type of certainty to where things are headed.
Exactly.
Exactly. Got it. Well, Dr. Nomi, appreciate you for coming on and everything. Where can people just connect with you and read some of your work?
Yeah, so anyone who wants to follow what we do and the model portfolio recommendations we put out on a regular basis can go to printsites.substack.com and decide which of those products might work for you to follow these trends and where you can invest as well.
All right, you all. I'm a subscriber, so be sure to subscribe. I mean, there's free publications as well as paid subscriptions, so be sure to subscribe. I'll link to that in the description below.
Thank you, sir.
All right, thank you.